When someone is buying their first home, how do they figure out which type of loan to use? There are so many options.
That's right, there are many options, and the good news is there really are three main programs most buyers need to understand: FHA, conventional, and VA loans. Each one serves a different buyer profile, and once you know which profile fits you, the decision is usually straightforward. Most people overthink this, but a 20-minute conversation narrows it to one.
Why does the choice of loan program matter so much? Isn't one mortgage pretty much the same as another?
The program choice is so important because it's one of the most expensive decisions a buyer makes, and most people treat it like an afterthought. The program you choose affects your interest rate, your monthly payment, your down payment requirement, and even in some cases whether you even qualify. Those variables add up to real money. We're talking about differences of $200 to $400 per month in some cases, depending on the loan size and your credit profile. And the selection isn't complicated, it's just not something most buyers are ever taught. You get pre-approved for a loan, you're told you qualify for this, and you assume that's the best option. It may not be. The right program is the one that fits your credit, your down payment, your service history if applicable, and your long-term plan. That's a 15-minute analysis, and it can save real money over the life of the loan.
What's the biggest misconception buyers have about these programs?
Yeah, one of the biggest misconceptions buyers has about these programs is the FHA is always the easy loan and conventional is the good loan. That framing is wrong and it costs people money. FHA has lower credit score requirements. It goes down to 580 for a 3.5% down payment, and you can even go down to 500 if you have a higher down payment. That's genuinely useful for buyers who need it. But FHA also has mortgage insurance that stays on the loan for its entire life if you put less than 10% down. You can't cancel it by reaching 20% equity the way you can with conventional private mortgage insurance. For a buyer with a 680 credit score and 5% down, conventional PMI might actually cost less per month than FHA mortgage insurance, and it goes away when the equity hits 20%. That buyer may be better off in a conventional loan, even though FHA seemed like the easier path. The point isn't that FHA is bad. The point is the right program depends on your specific numbers, and assuming without analyzing is how buyers overpay.
Walk us through the three programs. What are the actual differences?
Okay, so conventional loans follow Fannie Mae and Freddie Mac guidelines. Minimum 3% down for first-time homebuyers. Credit score requirements typically start at 620, with better pricing about 640 and above. PMI is required of private mortgage insurance below 20% down, but it cancels when you hit 20% equity. Most buyers with solid credit end up here. FHA loans are government-backed, 3.5% down at a 580 credit score. It's more flexible on your debt-to-income ratios, but mortgage insurance is required regardless of the down payment. An upfront premium is added to the loan plus a monthly charge. It's best for buyers with lower credit or higher debt loads. VA loans are eligible for veterans, active duty service members, and surviving spouses. There's actually no down payment required at all, no monthly mortgage insurance, and it's competitive rates. So there is a one-time funding fee, but no ongoing mortgage insurance cost. For anyone who's served, this is almost always the strongest program available. Use it. Three programs. The right one depends on your credit, your service history, and your down payment. Most of the time, it's clear after one conversation.
Give me a real example where the program selection made a real difference for someone.
Yeah, real life example of the right program selection. I had a veteran come to me, 9 years in the service, honorable discharge, strong income, and good credit. He came in asking about FHA loans because his agent had mentioned it and he assumed that's what he needed as a first-time homebuyer. When I asked about his service history, it turned out he had full VA eligibility he'd never used. He literally didn't even know that benefit existed. Here's the comparison on his specific purchase. A $420,000 loan. FHA is roughly $14,700 down, plus monthly mortgage insurance. VA, 0 down, 0 monthly mortgage insurance. Same rate roughly. Over 5 years, the difference in payment alone was over $20,000, plus the down payment he kept in his pocket. He had no idea and almost didn't get it because nobody asked the right question.
Is there anything buyers usually miss in this decision?
Yeah, one thing buyers usually miss in their decision is how seller concessions interact with program guidelines. Each program has different rules on how much the seller can contribute towards the buyer's closing costs. VA, FHA, and conventional all follow different amounts. In a market where sellers are offering concessions, the right program can allow you to negotiate more seller contribution, which reduces your cash to close. That's a real negotiating advantage most buyers don't think to ask about. Also, loan limits. FHA has county-based loan limits. Conventional has conforming loan limits that adjust annually. And in high-cost areas, you may be looking at a jumbo territory above those limits, which is a different product entirely. Knowing where your target price falls relative to the limits affects which programs are even on the table for you.
What's the most common mistake you see buyers make when choosing a loan type?
The most common mistake I see buyers make regarding their loan type is letting the lender choose for them without asking why. A buyer gets pre-approved for FHA and says, great, without asking if conventional was analyzed, whether their credit profile can get them better terms, or whether they have any program eligibility they're not aware of. The responsible question is, what programs did you compare, and why is this one best for my situation? If a lender can't answer that clearly, that's a signal. You are not just a file to be processed into the nearest qualified box. You have a specific financial picture, and the right loan is the one engineered for that picture. Ask the question.
How do they connect with you to figure this out?
Yeah, if you'd like to connect with me to figure this out, I'd say you can take the home loan quiz on my website. There's a path that walks through exactly this program selection question based on your situation. I'll review it personally and come back with a real recommendation. Or reach out directly. Program selection analysis takes about 15 minutes. It might be the most valuable 15 minutes in your home buying process.